In this video, we'll take a closer look at some of the more common candlestick formations. Let's take a closer look at what we will cover. We'll start by looking at some of the more common candlestick formations. These are the patterns that nearly every trader out there is aware of, and because of that, they carry a lot of weight. Candlestick patterns can help you identify areas where you need to get out of trades before they reverse, and they can also be used to tell you when you should not get into a trade. So we're going to look at some of the more popular candlestick patterns. We'll start by looking at the engulfing patterns. We'll then look at haramis, dojis, hammers, and hanging man. We'll look at the inverted hammer and the shooting star, the railroad tracks, and then we'll look at wicks in general. Let's get started. We'll start off by looking at engulfing patterns. Here we can see the bullish and bearish engulfing patterns. An engulfing pattern occurs when a small-bodied candle is engulfed by a big-bodied candle with the opposite color. Bullish engulfing patterns usually appear at the bottom of a trend, while bearish engulfing patterns usually appear at the top of a trend. On the image on the screen, you can see that we have a bullish engulfing pattern on the left-hand side. You'll notice that we have a small-bodied bearish candle on the left, and it is followed by a much larger bullish candle. The pattern is complete once the bullish candle has formed. On the right-hand side, you can see an example of a bearish engulfing pattern. Here we have a small bullish candle with a small body, and next to it, we have a bearish candle that completely engulfs the bullish candle. This is a bearish engulfing pattern. The pattern is completed as soon as the bearish candle closes. Let's take a look at another pattern. This one's called the harami, or the inside bar. This occurs when a candle with a large body is followed by a candle with a smaller body. The body of the second candle is contained within the body of the larger candle to the left and is of the opposite color. Now let's take a look at one of the more popular candlestick patterns. This is called a doji. It is valid when it appears at the top or the bottom of a market move. The open and the close price is the same or very close to being the same. The body is very narrow as the candle opens in the same place it closes. The length of the upper and lower shadows are small as the market has lost the momentum it recently had. Now there are a number of different types of dojis. Let's take a look at another type. This one's called a long-legged doji. The open and close are at the same price, but the upper and lower wicks are very long. The market is frantically looking for a direction. This is a period of indecision, but at the top or bottom of a trend, the temptation for the market to reverse is very strong. Let's look at another doji. Next, we have the gravestone doji. With a long wick, the open and close of this doji are at the bottom of the candle. It is a great formation denoting the end of an upward trend, but can, on rare occasions, also be found at the bottom of a trend. It is also referred to sometimes as a pin bar. Gravestone dojis are usually found at the top of an upward trend. The market goes up, forms the long wick, comes back down, closes, and then you can expect price to go lower. Let's take a look at another one. The dragonfly doji is the opposite of a gravestone doji. Its open and close are at the top of the candle formation. This is a formation that will clearly determine the bottom of a trend, but will occasionally appear at the top of a trend too. It is also referred to as a pin bar. Dragonfly dojis normally occur at the bottom of a downtrend, or at the end of a downtrend. The candle opens, price moves downwards, it then moves back upwards before the candle closes, and then you can expect price to start moving upwards. That's it for dojis. Let's take a look at another type of candlestick pattern. Next, we have the hammer and the hanging man. These patterns look exactly the same, but they get their name from where they appear. The hammer pattern usually appears at the bottom of a move, while the hanging man usually appears at the top of a move. The candlestick normally has a small body and a long lower wick, with either no upper wick or a very small one. The length of the lower wick is approximately 2 times the length of the body. This is also what qualifies it as a hammer or hanging man pattern. When you find a hammer pattern at the bottom of a move, it means that price is likely to reverse and start moving upwards. On the other hand, when you see a hanging man pattern form at the top of a move, it is a sign that the market's running out of steam and is about to reverse and start moving downwards. Let's take a look at another pattern. The inverted hammer and shooting star. This is essentially the same as the hammer or the hanging man pattern. The only difference is that the wick is at the top. The inverted hammer appears at the bottom of a move. The shooting star appears at the top of a move. The upper wick is double the length of the candle's body, and it either has no lower wick or a very small lower wick. The inverted hammer usually forms at the bottom of a trend. Once the hammer has formed, we can expect price to start moving upwards. It denotes the end of a trend. The shooting star usually appears at the top of a trend. Once the pattern has formed, we can expect price to start moving lower. Let's take a look at another pattern. This is called the railroad tracks, and this is an instance of a quick change of mind. Railroad tracks are made up of two similarly lengthy candles that are longer than the average surrounding candles. It shows a strong surge in one direction, followed by an opposite candle. In the case of a bullish railroad, you can see that we first have a long bearish candle, and next to it we have a long bullish candle. This is telling us that while price was initially looking to head downwards, it's now reversed or changed its mind, and it's starting to move upwards. In the case of a bearish railroad, you can see that it starts with a long bullish candle, and the next candle is a long bearish candle that is roughly the same size as the previous one. This is a sign that the market was heading upwards and is now starting to reverse and move in the opposite direction. Railroad tracks can be good reversal candles in fast-moving markets. They can also be found in relatively quiet times as well. In these cases, it's almost like a glitch in the works. There is very little in the way of an increase in momentum. The railroad tracks in a quiet market should not be traded, or should be traded with extreme caution. Now let's talk a little bit about wicks. Without looking for specific candle formations, the wicks are important to pay attention to. Whether or not the candle body is longer or shorter than the average, a long wick will often point to a change in direction. This is useful information for traders. A long wick on a single candle means that during that formation of the candle, there was a more than usually aggressive battle between the bulls and the bears. Whoever was able to push the charge back to actually form the wick will generally keep pushing. An initial power surge upwards by the bulls is met with retaliation by the bears. The bears defending their control over the market will continue to be aggressive for a short while afterwards. So this would be a good place to look to enter a sell. Let's take a look at an example of simultaneous wicks. Simultaneous wicks are a series of wicks. This is a heads up to a change in market direction. As price keeps trying to push in a direction, it is being continually met with resistance. Eventually, this resistance will take over and push price in the opposite direction. As you can see on the image below, we have a set of 3 candles. In the first set, you'll notice that it's forming relatively small bodies, but the wicks are being formed much longer above the candle body. This tells us that there is a potential for price to reverse and start moving downwards. On the right hand side, you can see another set of 3 candles. These are also forming slightly smaller bodies, but the lower wicks are much longer. This is a sign that the market is running out of steam or running out of downward momentum and will start to be moving upwards. So as you can see, candlestick patterns are very important. They give us a lot of good information that we can use to base our decisions to enter or remain in any trades that we may take. Thanks for watching. I look forward to seeing you in the next DVD. Bye for now.